I'm going to take you, of course, those who joined me in the past can see what this means, why this gentleman is here. This is something standard I have, and some of you would already know what that meant. So this slide is about the session plan, what I'm going to be talking through in this next 60 minutes or so. Some of the introduction, some history I'm going to talk about, the structure, some business information, fact of the case, some key question that I have in my mind, what the taxpayer was actually saying to put forward his comment, his argument in front of the court, what the tax inspector, the tax authority was saying, and finally, what the tribunal did come up with. So what is the lesson? What's the takeaway from this case? And finally, this is what me, a typical as usual. Why I wanted this gentleman is because of this. Mr. Humor, Baba Ramdev all around, and I would always want to bring him in my session if I could. Right. So I'm going to take you to the case straight away. This is the case. Very quickly introduction in picture. AVIC means Aviation Industry Corporation of China. So on one side, AVIC Beijing, on the other side, AVIC Kenya. And in between, the Kenya Revenue Authority, KRA, something equivalent to IRD in Nepal. So here, there are transactions between AVIC Kenya and AVIC Beijing, China. And those are the transactions are subject to transfer pricing legislation as part of the international taxation regime. Something the Kenya Revenue Authority didn't like it, and they come up with some alternative methods, which, of course, the taxpayer didn't like it, the company, AVIC Kenya. And the company objected, which again, the tax inspector didn't like it, and therefore the company took the case to the tribunal. I'm going to take you to the structure of this company and the case. First, I call this company as AVIC Group. AVIC Group does have AVIC Holdings China. It goes back 1979. And by the way, this AVIC Group was set up back in 1951 by the Communist Party of China under one of the ministry. So this AVIC Group is the state-owned corporation, not a private company. AVIC Holdings, under that, there is something called AVIC Beijing, which is the 100% subsidiary, and under that, AVIC EA Kenya, which was recently established not very long ago, just under a decade. And you can see the full form or the extended name of all these. AVIC Holdings means AVIC International Holdings Corporation China. AVIC Beijing China means AVIC International Beijing Corporation Limited China. And the AVIC EA Kenya means AVIC International Beijing EA Company Limited. You'll see the structure, that's 100% subsidiary, that's also subsidiary. And what happens here is this. AVIC Beijing export goods to Kenya via AVIC EA Kenya. So basically, AVIC Kenya is importing goods from AVIC Beijing. Remember, they are related companies because they are the subsidiaries. Also, AVIC Kenya receives some admin and other management support from the AVIC Beijing because they are subsidiary companies, they are associated. In return of those goods, the billing is done on something called RPM. RPM means resale price method. I'm going to touch base briefly on this. What is resale price method? I'll explain to you what they are going to import, what they do, and so on in a minute. But it's just an initial picture. And what the AVIC Kenya does is once those goods imported, they do some sort of assembling into other machinery, motor vehicles, other spare parts, and even some trucks and the heavy-duty equipment. So they assemble it and they sell it to the local market in Kenya. So this is the business story briefly. Every terminology we have here has a specific meaning and the context. So just bear with that. Furthermore, in July 2021, the Kenya Revenue Authority, the tax inspector, didn't like this RPM method. resale price method of the billing. So what they did is they issue what is called notice of intention to audit for the purpose of not just the TP, not just the transfer pricing, for corporation tax, which is obviously the part of transfer pricing there, PAT, PAYE means the salary, TDS, and WST means the withholding tax. I will be going through some of them, not all of them. So this case is relatively big. The judgment was about 80 pages long. So I'm trying to summarize that within under an hour. So I'll be trying to cover and touch base the transfer pricing area of this case. And what the tax inspector was saying that, no, I don't want RPM, not the resale price method. We want TNMM. TNMM means transactional net margin method. So what they are saying is when Kenya got the bill, when AVIC Beijing was billing to the AVIC Kenya, they used the method called RPM, retail price method, but that's not right. They are saying the right method would be TNMM, transactional net margin method. So we're going to discuss what they are briefly, and we carry on building the case further. In China, the corporation tax rate 25%, and the year end is 31 December. In Kenya, corporation tax rate is 30%, and the year end is 31 December. As it happens, there is a double tax treaty between China and Kenya back in 2017. Not very long ago, but still they have one, which is between China and Kenya. So this is a picture, generally. Let's look at it further. I want to discuss through what the business, what the AVIC actually does. AVIC Beijing does is buying various products from the independent manufacturers. Remember, independent manufacturers, and later sells them to the AVIC Kenya without any value addition, means without any changes, without any modification, without any further help or support or assembling of those parts. So basically, whatever they are buying, they are selling. Simple as that. Let's look at further. And those products are some sort of automatic parts, the other machinery and vehicle parts, very heavy duty equipment, as well as trucks, etc. So some of them, they are just buying and selling to Kenya, and the Kenyan company also selling further to the third party local market in Kenya. Some other items, what they do is they would assemble and sell. Let's look at here. AVIC EA means AVIC Kenya then assembles them into the finished product like motor vehicles and sells locally. Here's the word assemble. Please make a note of that. I'll come on to that again in a minute and you'll see what do I mean by that. In Kenya, AVIC EA is the approved importer for what is called completely knocked down kits. What that meant is something like, I'm sure some of us very clearly knows about how the computer business works in Nepal. What they do is they buy independent items. They buy individual items from China. They put together, they assemble into a part, and they make the CPU and they sell it outside in Nepal, right? There are quite a lot of businesses they do in Nepal and other parts of the world as well. And that's called completely knocked down items. So they buy individual items like motherboard, like RAM, like memories, this and that, and they put together into a box called CPU. They make the computer ready and they sell out in the market. Similarly, even for the motor vehicle industry, they do the same. For example, a lot of Korean car gets built in India. What they do is they buy all the individual items, individual parts from Korea and other part of the world, and they assemble into a car and they sell it in India as well as in Nepal. And therefore, we can buy cars in Nepal because it comes slightly cheaper. Now, AVIC Beijing was charging for those products using what is called resale price method. We'll come on to that. What does that mean? And that RPM benchmarking, retail price method benchmarking is somewhere between 7% to 13%, and the median is 9%. It's just a math. I'm not going to go into it, but just bear with that. This is basically the industry benchmarking. Let's look at it further. I'm going to talk through slightly history here. I did start 1951, AVIC, Aviation Industry Corporation of China, part of the Bureau of Aviation Industry, part of the Ministry of Heavy Industry, was set up by the government. Therefore, it's state one. And this AVIC actually does a lot bigger things. We may not have heard about this company, but it's very common, very famous in China and also Kenya and some other parts of the world. It does do jet engine, fighter, multi-purpose civil aircraft, bomber, domestic aircraft. Not only that, many other machinery-related items they do work on. In 1979, they set up another subsidiary called AVIC Holdings to expand their market internationally around aircraft, spaceship, engine, passenger jet, and other electronic items like mobile, radio, calculator, etc. You can tell they are selling as big as jet and as small as calculator. In 1992, AVIC Beijing was set up especially to work in the areas of automotive, motor vehicle, parts, and aviation-related products, also pharmaceutical equipments, to expand further internationally. And of course, Kenya. So for the Kenya, they set up this AVIC Kenya as subsidiary to expand their business from China to Kenya as part of their international expansion. So this is where we are. Now, from this point on, we will be discussing between AVIC Kenya and AVIC Beijing, leaving other part of this associated company aside, because these two are the primary part of this case study. Let's look at this further. Before I move on, because I talked about the retail price method and transactional net margin method, I'm going to very quickly touch base on the types of transfer pricing method. Generally, there are 5. I'm not going through each of them in detail. I'm just going to be listing here. So those 5 methods are divided into 2 major methods called traditional transaction method. Please note down transaction method. Within the transaction method, comparable and controlled price, cost plus method, resale price method. This is the one the company was using. Yeah. The cost plus method is something we're going to discuss in our future session, and the other methods we're going to be discussing in future session as well as we go along. And the next major method is what we call is transactional profit method. Under this, we have 2, transactional net margin method, profit split method. So you can tell the taxpayer was using RPM, resale price method, and the tax inspector is using TNMM, transactional net margin method. So here is the battle between these 2 methods. And this is the crux of this case. There is something else as well, which you'll see in a minute. I have one more question, which I'm not going to answer, but probably leave this for the discussion in future. Can any other method outside these 5 also be used for the purpose of transfer pricing? This is my very general, humble question for you. And what the OECD guidelines say about this means the other method. So I leave this for now for you to think it through. So I'm going to take you to these 2 methods very quickly, resale price method and transactional net margin method, because without understanding these 2, there may be a little difficulty to understand the case itself. So what is retail price method? I'm going to very quickly run through. This is based on the transaction number 1. So the comparable transaction will be looked at and attempted to find the open market price. What that mean? The retail price method would normally use for the tangible transaction, tangible assets, tangible property transaction, unlike some other methods. Some other methods can be used for both service, goods, as well as other financial transaction and so on and so forth. But RPM is generally used for tangible property transaction. And this looks right because buying all those motor vehicle and the automotive parts are the tangible properties. So that looks okay. Further, the RPM looks at the gross margin percentage. And we all are accountant, we know what the gross margin is. The gross margin simply means the gross profit divided by net sales. So RPM looks at the gross margin level. Gross margin means way above the profit and loss. What we call is the trading account. So sales less direct cost is going to be gross margin basically. Of an independent distributor, please note this here, distributor. Let's look at it. Then this percentage is used to determine the appropriate margin that should ideally be earned by the associated companies on the controlled transaction. So what this means is, first, in the industry, in the market, they try and see what is the generally gross margin of this distribution business. And they try and pick that, and they compare that against the company's individual gross margin percentage. So it is some sort of a ratio analysis, financial analysis. First, people look at the tax inspector looks at the industry average in terms of that nature business, primarily the distributors, and see what is the gross margin there generally. Just think about it. When you look into 20 different companies working in one industry, their financial statement, you can get an idea, right? This is roughly there and there about X percentage gross margin. So if another company comes into that industry, then the tax inspector would assume similar gross margin. That is the basis. So the retail price method looks at the gross margin, the higher part of the financial statements, generally. And the OECD guidelines, paragraph 2.38, talks about the method, talks about this particular method and where this can be used and so on and so forth. Then what is transaction net margin method? Transaction net margin method is based on net profit percentage. Now, here is a difference. So you can tell RPM is based on gross profit percentage, and the TNMM is based on the net profit percentage. So here is one major difference. So the TNMM looks at the bottom line of the financial statement, and RPM looks at the slightly above the line of the net profit, just after sales and the direct cost of sales. So this percentage is a guide then compared to the net profit of the other independent enterprises in similar industry for the comparable uncontrolled transaction. So basically what is happening here is that the AVIC Beijing and the AVIC Kenya are associated companies. So the tax inspector is trying to see if they are manipulating their profit, if they are manipulating their selling price. That is the case. Now, the general guidance is that the transaction net margin method is effective for product manufacturers with relatively straightforward transactions. So you can tell RPM is generally useful for the distributor business. The transaction net margin method is useful for the manufacturer business. But again, this is just a guidance. There's nothing specific, nothing formula as such. This is a guidance for the purpose of our case and generally. So what further is this? The transaction net margin method may not be a good match for the companies with complex business model, such as high-tech companies with intellectual property, etc. For example, brand, trademark, formula, etc., so on and so forth. It may not be useful. So here is a fight between one against the other. RPM looks at the gross margin, TNMM looks at the net margin. That is something as simple to take it from this slide. Let's carry on. So there are two types of transfer pricing adjustment called primary adjustment and the secondary adjustment. This is the one that I'm keen on, secondary adjustment. And you'll see what does this mean in a minute. Let's see. This is the sum of the fact of the case. This goes back 2016. You can tell the inspector issued the notice to audit in 2021, but the case goes back up to 2016. Initially 16 to 21, then extended up to 2023. In July 2021, the tax inspector issued a notice of intention to audit, which we said earlier. Let's look at the timeline. This issue is just not the transfer pricing, but a lot wider. You'll see VAT, salary, withholding tax, etc. And in November 2022, the tax officer issued something called pre-assessment of tax for the years 2016 to 2020. The company, AVIC EA, responded to this, objecting the pre-assessment. Of course, the company didn't like it, and they objected in January 2023. Please note the timeline, how it can go. In June 2023, the officer raised an assessment, additional assessment of about $4 million equivalent per transfer pricing, VAT, withholding tax, including appeal, penalty and interest, etc., going back 2017 up to 2023. As you can see, it's more than 5 years. Please note this. Despite the company responded objecting the pre-assessment, the tax inspector didn't bother, moved ahead and raised the additional assessment of $4 million equivalent in June 2023. In July, just after a month, the company responded again, objecting this $4 million assessment. But in September 2023, the tax inspector, of course, is the boss. Why he listens to anyone? He issued the decision called objection with his assessment revised to 3.9 million. You can tell it was 4 million revised down to 3.9 million. So they may be saying that, look, we have looked into your objection, your response, and we have reduced it from 4 million to 3.9 million. But it's not really what the company is probably trying to do. Now let's look at it further. The total transfer pricing adjustment was about 3.3 million. So quite a bit. The transfer pricing adjustment means they are increasing their additional sales by 3.3 million in the books for the 2017 up to 2021, based on transactional net margin method, disagreeing the RPM. So what the tax inspector is saying here is that, look, we don't agree with your RPM method. You are doing the intercompany businesses. You are doing businesses within your group, one in China, one in Kenya, and you use the method RPM to value the goods. But we think TNMM is more appropriate in the context than the RPM. So this is the main battle. And the battle is around $3.3 million equivalent times whatever 30% corporation tax rate, of course. So in October 2023, AVIC EA obviously dissatisfied and went to the tribunal. And in Kenya, they have got something called TAT, Tax Appeal Tribunal, under Republic of Kenya for an appeal. So initially, the company put through notice of appeal. So what this means is the company is saying, we want to appeal. That is the first step of appeal in the tribunal court. Let's see what happened. A lot of things happened. Primarily, I'm picking up two cases, additional revenue and something else. This case involves many other things, but I'm picking up primarily two, which are relating to the transfer pricing. One, primary adjustment, two, the secondary adjustment. So the first thing is additional revenue. The tax inspector used TNMM method, and this resulted in additional taxable revenue, which we saw earlier, about 3.3 million going back 17 to 21. The second is something called deemed dividend. So what the tax inspector is saying here is this: look, you should have billed the Beijing company 3.3 million more. Basically, that is the logic. You did not bill enough, which you're supposed to have billed. So here's a 3.3 million under value, under sales in your books. That's going to be liable to corporation tax at about 30%. That's one thing. Second, if you have billed 3.3 million, you'll get your money, right? If you have billed 3.3 million more, you get that 3.3 million from Beijing company to Kenya company. Is that not right? It is. But where is that 3.3 million money then? It is sitting in Beijing, as opposed to it should be in Kenya. So what the tax inspector is saying is that, look, you did not bring this 3.3 million money, which you should have brought. Therefore, we treat this money because you didn't bring as if you are paying deemed dividend from AVIC Kenya to AVIC Beijing. That's the logic. I know number of tax jurisdictions, number of countries have different variation of the secondary adjustment, mostly in around interest. I know India has one. Kenya got one as well. We have recently got the first transfer pricing directive in Nepal. I looked at, I couldn't find secondary adjustment provision in the guidance. Maybe I missed out. I'm going to double check, but I didn't find something similar to the secondary adjustment in the guidance issued by IRD back in October. So here the interesting bit is the second rather than the first for me. So the first is a fight between two methods, RPM versus TNMM. The second is the deemed dividend. It's like a double hit, double blow. Basically here, you didn't bring this money, which we think you should have brought. You should have charged to Beijing. And the money should be in your bank account. Because the money isn't in your bank account, we assume equivalent that you are paying dividend of this amount equivalent back to Beijing. What simply means the money you should have collected from Beijing, you didn't collect. So we treat that as dividend that you paid back to them. Simple as that. I know it's a little bit complex concept. As I'm saying, the secondary adjustment is always complex thing in transfer pricing. And not every jurisdiction have that. Of course, a few they do, including India. As I said, not sure about Nepal. We have just started, so we'll look at it in future more. Here, the tax inspector assessed withholding tax of about $368,000 equivalent on deemed dividend. So what they are saying is, now we think or we consider that this 3.3 million you have given, distributed dividend back to your parent company in Beijing, at least deemed, because you didn't bring that money here. Therefore, on dividend, there is withholding tax provision in Kenya. So we want to charge you withholding tax on that deemed dividend, which I know you haven't paid, but equivalent to pay because you haven't collected, plus interest and penalty. If you look at it there, the amount is probably isn't that high, but the significance is. So within the transfer pricing regime of this case, I'm picking up these two. There are a couple of others as well, but these two are the primary bits I'm going to be talking through. Let's see what happens. So again, I have three key questions here. First question is, why tax inspector goes back more than 5 years? That's the first question. Second question, why retail price method is correct or not correct, which already looked at. And why TNMM is correct or not correct, and what is the justification. In this case, tax inspector went more than 5 years. Therefore, I have put one more question. Why inspector went more than 5 years? Because in many countries around the world, if the tax inspector wants to go back more than 5 years, in some countries more than 6 years, in some countries more than 4 years, then there has to be the special provision, a special reason. Or they just can't go back any number of years they like to go back. So there is a provision. Let's carry on further. So what the tribunal is saying, the judgment was very recent, 22nd November 2024, just a couple of months back. So this case is relatively fresh, new, but the history, the case behind the case goes back many years, as you can see. It just decided a couple of months back, but the case goes back as far as 2016. But before we hear the tribunal, let's see what the taxpayer company is saying here. So taxpayers' argument. First, in November 2023, the company furnished with a statement of fact to the tribunal. That's the usual process. Appeal allowed? We don't know. I think partly allowed or fully allowed. What are the grounds? We'll look at it. In August 2024, not long ago, the company filed its written submission to the tribunal. So the full detail of what they think, their logic, their comment, their argument, and all that. So first thing is, why more than 5 years? So taxpayer is arguing this wasn't a case of fraud or evasion. Then why tax inspector is going more than 5 years? That means in order for the tax inspector to go back more than 5 years, they should have a sound ground that the taxpayer was trying to evade or taxpayer is doing something fraudulent. That's the first ground they're submitting. Second, transaction net margin method or the RPM. Let's look at their logic. What they are saying is tax officer is incorrectly using transaction net margin method as the most appropriate method for the arm's length price, means the open market price, which resulted in transfer pricing adjustment of 3.3 million. So the first point they are saying is tax inspector is incorrect. Why incorrect? Let's look at here. This adjustment is resulting an unimaginary and unrealistic additional revenue. This is impossible. That's what they are saying. This is an unimaginary and unrealistic additional revenue of 3.3 million just because of moving from one method to another method. And they are saying AVIC Beijing is buying product from independent manufacturers and selling to AVIC Kenya without any value addition. So basically, it's a kind of a distributor. That's what they are trying to say. And AVIC Kenya then assembled them into finished product and sold in Kenya. We already touched base on this. So the retail price method is the most appropriate method in this case because AVIC EA is kind of redistributing after assembling of product from buying from AVIC Beijing. So what they are trying to say is that the AVIC EA is not manufacturing, it's assembling. I have this question for you. What is the difference between assembling and manufacturing? I'll come on to that in a minute. I think that has a very crux of this case. And they also refer to the various guidance. And they refer to the benchmarking as well. So the next, their argument continued, deemed dividend. In this case, they really heavily argue. They are saying, how could a company distribute dividends if it has a negative reserves of $560,000? Accountant, we know about it. If there is a negative reserve, you cannot do the dividend. We know that. So first point, they put this forward. The second, how could a company distribute dividends if it has overdue creditor of more than 7 million? So they have a lot to pay as well. So how could you do that? So the third one is, how could a company distribute dividends when additional salaries of about 3.2 million per expat and seconded employees have not yet been paid a factor? So what they are saying is company doesn't have any money, company has the negative reserve, company has a lot to pay, and in that case, how a dividend can be paid? How the distribution is going to be possible? Although it's being deemed, it's still deemed is equivalent to pay. So these are their logic. Let's look at what the tax inspector is saying. So number one, again, it's a standard court procedure. They also filed their preliminary objection and then their written submission and then their statement of facts, etc., to the tribunal in the same way as the taxpayer was doing. More than 5 years, they put their own logic, which I'm not going to bother talking about it. They are just giving their own timeline, etc., here and there, which honestly I wasn't too happy, but there isn't really important thing to talk about. I think they were not right, but we'll come on to this in a minute. The second is the important bit again, why one against the other, why they wanted to go to the transaction net margin and not the RPM. Here is the logic. AVIC Kenya deals with heavy motor vehicles, but was provided comparable from companies who deals with light vehicles. Look at the comparable factor. I have been saying this, no matter whatever you want to do within the transfer pricing regime, one thing you want to get it right is the comparability analysis. We want to compare correctly. When you compare two mobile, if you pick one from Samsung and another one from Apple, you may not be doing the like with like comparability analysis, for example. Just an example. So the first thing they are saying is the company provided comparability analysis, which I don't think is right. That's the first thing they are saying. So here we can tell AVIC EA involved in assembly, fabrication, and distribution of heavy commercial vehicles, construction machinery, and associated spare parts. So what they are saying is AVIC Kenya is heavily involved in just more than assembly. They do other things as well. They do design, they do fabrication, and all that. Therefore, the product and function comparability factors are not satisfied. It's a bit more technical. What the tax inspector is saying is, you provided us with the comparability factor, comparability analysis, taking Renault, VW, Toyota, Nissan, etc., but those companies are only producing light vehicles. You are producing heavy vehicles. So they are not directly comparable. Therefore, your analysis is not up to the mark. So you are not doing the correct comparability analysis. Therefore, we are not happy. That's the tax inspector is saying. The second is, it is difficult to use resale price method to arrive at the market price, arm's length price, where before resale, the goods are further processed or incorporated into a more complicated product so that their identity is lost or transformed. Imagine you buy all those chips, motherboard, and this and that, and you convert into a computer. That's a very big transformation. Same for the car and the other vehicles, right? You buy a lot of individual parts and you put it together and you make a car. So you are, of course, transforming altogether. That's what they are trying to say. Therefore, they think RPM used by AVIC Kenya is not the most appropriate method. So the question is assembling versus manufacturing. This is the question in this case, in my opinion. The AVIC is saying we're assembling. The tax inspector is saying, no. You are actually manufacturing. What is right? We'll leave it at that. But this is one of the main points. If assembling, if you are just distributing, if you are buying relatively semi-finished product and just doing a quick assembling and distributing, reselling, then resale price method may be okay. But if you are doing a lot of modification equivalent to manufacturing, then resale price method may not be comparable, may not be the correct method. That's what the tax inspector is trying to say here. Let's look at this further. What they are saying. Again, tax inspector, they did something called FAR analysis. FAR means function, assets, and risk analysis. That's what they did. What they're saying is we did our own FAR analysis using the tax transfer pricing consultant. And we come up with TNMM being the correct method as opposed to RPM. So what they're saying is, based on our analysis, because we did the independent FAR analysis using TP consultant, we come up with TNMM as the more appropriate method than the RPM. Because this company is not just redistributing what he bought from Beijing, but doing a lot more work on those products before selling. So this company, AVIC Kenyan, made a valuable contribution to the whole of the value chain of the business and the profit. And in this case, net profit margin would be more appropriate. That means transactional net margin method is more appropriate as opposed to the resale price method. So what he's saying is we should be looking at the net profit, not the gross margin. Basically, that's what they are trying to find out, trying to argue, and trying to sell their ideas against the tax inspector, sorry, the taxpayer in front of the judge. So dividend. What they're simply saying is because transaction net margin method is the appropriate one, there is a transfer pricing adjustment. And therefore, deemed dividend is the byproduct of that adjustment. So of course, it is valid. That's what they're trying to say. So because the first one is right, the second one is also going to be right, basically. The first one is the primary adjustment, second one is the secondary adjustment. We are saying the first one is right, therefore the second one is automatically going to be right because it is derived from the first adjustment, that is increase in sales by 3.3 million under the different method, and that method is TNMM. Now, here it is. So 22nd November 2024 was the judgment day from tribunal. Let's see what the tribunal is now saying. First thing, appeal was allowed. That's number one. There are a lot of admin points which I have not discussed here because I wanted to make this case study within an hour. But what are the grounds? Let's look at it. First thing, more than 5 years. Under the Section 31 of the Procedure Act, the judge is saying you cannot go more than 5 years. Simple as that, which I knew. When I first read this case, I knew this 5 years isn't right. More than 5 years isn't right. And the first thing appeal allowed based on this is that the tax inspector is wrong going back more than 5 years. That's first. The second, again, coming to the same point, which one is correct? The judge heard opinion from taxpayer and the tax inspector, both sides, on the same point. One is saying RPM is correct, another one is saying TNMM is correct. Now, what the judge thinks is correct. Let's look at this. First, control transaction, we know about it because they are associated companies, 100% subsidiary from Beijing to Kenya. The various products were purchased from AVIC Beijing. And the Section 18, subsection 3 of Income Tax Act of Kenya talks about the market price, market value, arm's length price, basically. I did have a whole slide up for this Section 18, but I didn't want to bring it here to make it too long. So basically, this section talks about the market price. What they're saying is the arm's length price should be used. Something similar to Section 33 we have in the Income Tax Act 2058 in Nepal. Yeah. So the arm's length price, no question. The second is this: comparability analysis is the critical. Are those comparable reliable? And therefore, are those arm's length price actually reliable and comparable? So note this point. Here, even the judge is saying, look, comparability analysis is important. No matter whatever you do, you need to get this right. So judge appears slightly leaning towards tax inspector here. Again, we haven't come up with the final judgment. The judge also referred to the OECD transfer pricing guidance. And judge further commented on this one. Economically relevant characteristics or comparability factors that need to be identified in the commercial or financial relation between the associated entities. What that meant in simple terms is that when you are performing the comparability analysis, you need to be looking at the economic characteristics of the business of each side. Let's look at this. So economically relevant characteristics means first look at the contractual terms. Second, do the same functional analysis, characteristics of property transferred or the services provided, and economic circumstances, business strategies, etc., etc. So basically, you are not just looking at the numbers, you are also looking at the economic substance before you come to a method against the another. So before you come to the transfer pricing correct method, you need to be doing the comparative analysis, comparability review. And in order for that, you are not just looking at the numbers, you are also looking at the economic factors, economic analysis, not just the financial analysis of each of those associated companies. And selection of the comparable, benchmarking study. Look at these. Remember what the tax inspector was saying. He was saying this company is producing heavy vehicles and providing the comparables from light motor vehicles. Here, judge is making the note of that and saying, is the selection of comparable correct? Is the benchmarking study correct? Is the RPM the most appropriate? And finally, judge also come up with TNMM as being the most appropriate as opposed to RPM. Therefore, the additional taxable revenue and therefore additional tax is due. So the judge is also coming and saying that given the context, TNMM is the most appropriate as opposed to RPM. Primary reason is that when the taxpayer was coming with the RPM method, the taxpayer did not provide sufficient comparability analysis and sufficient reliable comparators. That is the point. So the judge picked up the same point. Closely monitor this. The comparability analysis matters. You can't just say, oh, whole business fraternity is using this method, so I'm also using that method. You need to have your own analysis as to why you are using one and not the other. So unfortunately, the decision, the bulk of the decision, the measure of the decision went against taxpayer in favor of tax inspector. Furthermore, what's about dividend? Of course, because tribunal agreed with the transaction net margin method, the deemed dividend is the byproduct of that, and it is in the legislation. Therefore, tribunal agreed. But tribunal did one more thing. Withholding tax is allowed not after 2019. Sorry, not before 2019, only after 2019. There is a reason. First, tribunal agreed on deemed dividend, again in favor of the tax inspector. But tribunal come up with one more thing saying, but the withholding tax, you cannot put anything on the deemed dividend figure before 2019, only after 2019. So at least there is some relief for the taxpayer company. The reason being is that under the section 7, subsection 1, subsection B of the Income Tax Act 1973, additional income from transfer pricing audit adjustment are deemed to be dividend distribution only provided from the Finance Act 2018. So that means this deemed dividend rule was not there before 2019. But the tax inspector was trying to lump everything into one. Here, the judge distinguished one before November 2019 and the one after, because this rule actually came into play only after 2019 under the Finance Act 2018. So at least there is some relief for the taxpayer company, but bulkily this case went against the taxpayer company, AVIC, EA, but in favor of the in favor of the tax inspector. So let's look at this now. Finally, this is something I always want to say. Each party to bear its own legal cost. So the tribunal ordered whatever legal cost they have, each will bear their own cost, and one is not going to compensate the other. It sounds very reasonable. It sounds very normal, but we'll see in our future cases, things can go slightly different as well. But the tribunal ordered that whoever spend whatever money on this legal battle, you bear your cost, and don't look out for the other party for your cost to be borne by. So this is the case. Now, as always, I have this slide for you for discussion. I'm just going to bring everything here. So what is the takeaway? What is the lesson? 1, generally. 2, lesson for the tax authorities. 3, lesson for the taxpayer. And 4, anything else. So I leave the floor open